Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Flex LNG. They're an LNG shipping company. They pay over an 11% dividend right now. I'm going to be talking about kind of how safe is that dividend and sort of give you some look into the future at the company so that you can understand this a little bit better and make an informed decision. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Flex LNG, so this video should be for your entertainment purposes only because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. Okay, so Flex LNG, I'm gonna give you the bottom line up front if all you really care about is, my rough estimation, looking forward at the dividend. That 11% dividend is very juicy. I think it's moderately safe. Usually you see at a company with an over 10% dividend and you look at that and you say that's going to get cut pretty quickly. I don't think that's really a done deal for Flex LNG. It's not impossible. That's why I say it. I think it's moderately safe. And I might go through that in more details throughout this video. But if that was all you were looking for, if you want to get out of here, if you don't think it's super safe, there you go. That's the bottom line. In my personal opinion, I really think it's reflective of little to no capital appreciation, little no growth that this company is going to have. And that's kind of where it's at. That's why it's priced where it is. I'm going to go in this in more detail now. So, as I mentioned, Flex LNG, they're an LNG shipping company. This is, I assume, a photo of one of their ships. They take LNG from the LNG exporters and ship it to wherever the import terminal is, where they can then regasify the liquefied natural gas and use it for use it there to burn it for energy purposes. And they are let's say, I guess I don't know if they're fairly large. I think it's significant. They have 13 ships. Let me zoom in here so you can see this slide here. This is from their most recent investor presentation. They have 13 ships. The company does. They have nice names: Rainbow, Courageous, Constellation. And this slide here not only lists out their ships, it also shows the contract backlog that they have for all of these ships. By the way, hi Wilkaza, thanks for hopping on the stream. I saw you were here even before the stream started. That's amazing. But so this is an overview of all of their ships and how far into the future they are contracted for. So you can see some of these ships are contracted for quite a ways into the future, all the way through to 2029. And in 2024 specifically, all but one of their ships is contracted for the year. And a lot of these are contracted for some period of time, and then they have options for the person who has that contract to extend it into the future. And you can see if all of those options are exercised, they're pretty full. For most of their fleet, they're other than one ship, they're full all the way through 2026 if those options get exercised, and then for most of their fleet all the way through to 2027 and beyond. And so that's one of the things I think underpins this, this company and their dividend payments, is that they can really look out in the future at all of their cash flows and say, look, we know we've got all these ships under contract, we're going to be getting money coming in from all of those, all the shipping those ships are doing, and that helps them look out in the future and plan pretty well. So that's kind of the brief overview of their fleet. And one thing before I go into a lot of the numbers for this company, I did want to put one thing in perspective, and that is, this 11.2% dividend. This is the Yahoo Finance, shows it, right here, 11.19%. Let's call it 11.2%. That is again, an absolutely huge dividend for a company to pay. However, to put this into context, Flex LNG, I believe, is not a U.S. based company, and so per my understanding of taxes, I believe that means that for U.S. investors, which I think is a large portion of folks who are investing in U.S. listed stocks, and is one listed on the New York Stock Exchange, I believe that means that dividends from this company are not qualified, meaning they are taxed as just ordinary income. And so for a lot of wealthy people who are investing, their top tax rate is like 39 point something percent. And so if you do the math on this, let's pull up the calculator. 11.19%. Subtract off the 39%. Oh man, this is I'm top income tax bracket US. Let's double check this. 37%. Sorry, I was wrong. 37%. Clearly, it's not a problem I have. multiply that out and say, great, they're going to retain 63% of that dividend because it's, 37% goes to taxes. It is not qualified dividends. that puts the effective yield for Flex LNG after tax at just over 7.05%. I wanted to compare this against another company, Altria Group, right? This is one that this is a popular, high yielding dividend stock that a lot of retail investors, let's say, like. And I use this as a benchmark because I think this is one where we can look at a company and say, Altria Group is not going out of business anytime soon. At least that's the prevailing sentiment. I can't guarantee that, and I haven't done deep research in this company myself. I don't think I hold this anymore. I have at times in the past. I don't write it at the moment. Have for a couple of years at least. But the point that I want to make here is, this is a very high yielding stock, 9.76%, and I believe this is, these dividends would be qualified. And so if you run the numbers on that, 9.76%, and I think the top income bracket would pay 20% due to these dividends being qualified. And so you yield that out, and you're at a 7.8% yield, 7.81, let's call it. And so after tax, Altria Group, which is, I think, a stable dividend payer, not something going out of business, not at risk of cutting their dividend anytime soon, to my knowledge, is actually yielding higher than Flex LNG on an after-tax basis. And so I think the difference that we see here as to why it's so massive, over 11%, is partially explained by the fact that it is the tax treatment of the dividends coming from Flex LNG. So just one thing that I wanted to really call out and note here, where the sticker shock of seeing it above 11% might be kind of an exaggeration from what you'd initially just think of. So wanted to call that out, and this goes to also something I alluded to before, that I think Altria Group is a very, very apt comparison, because this is a company, if you're not familiar, they sell effectively cigarettes and associated things in that market. I believe this is a fairly steady company. I don't think there's a lot of growth expected for this company in the future, but I think it is expected to be stable, where they can continue paying this dividend for quite a while. Even maybe as their market slowly shrinks, and maybe the long-term prospects for the company are not great when you look out 20, 30, 40 years. But for the next 10, 20 years, I think it's expected to be fairly stable. And I think that's similar to Flex LNG, where if you go back and you look at their, let's go back, there are 13 ships that they have here. Most of these ships, I believe, I think I've actually got the chart over here. So this is the same list of their 13 ships. I think this is from their 2022 annual report. I don't think the 2023 one has officially come out yet. But you look at the years that they were built. They were all built between 2018 and 2021. Okay, so this company stopped getting new ships a couple of years ago. I do not believe they have plans as of right now to expand their fleet at all. So they have 13 ships, and this is kind of reflective of, if they don't really grow their ship count, they don't grow the amount that they can ship, there's not a whole lot of expected appreciation for the value of this company over time. They're valued at 1.4, 1.5 billion. It's not obvious to me that that's going to materially change. Maybe it will go up a little bit as they pay off debt, so the equity portion goes up a little bit. But I mean, in general, this company is not going to 5x or 10x even over a couple of decades. From intrinsic growth. Maybe due to inflation and the shipping market for LNG, that will happen slowly over time. But there's not really a growth story for this company at all. The story is they're going to continue operating these 13 ships. They're going to do it profitably. And all that profit that they make, they're going to pay out the majority of it as dividends to their shareholders. And so that lack of growth really, I think, explains why this dividend yield, that plus a tax treatment, explains why the dividend yield is so high, without really raising any alarm bells for me personally. So that's my interpretation of the dividend yield. Now I'm going to walk through actual numbers here to kind of underpin my analysis here. So let's look at some of their operational metrics. There's a couple of things that they look at, right? When they have these ships operating, they count up how many days are these ships operational, and they multiply this by effectively 365 times the number of ships, and that's how they got to, that gets you to a number, I think 47 something, right? So if I did 13 times 365, that would be 4745. And, they said they had 19 days of technical off-hire. I don't know why that's 19 rather than 20, considering that the difference is 20, from 4745 to 4725. But effectively, that's how many ship days they had operating in the year. Some of those ships were actually, they call it dry dock. They were, at a port where they were maintaining it or doing something there. I don't know all the details of what they do, but they had another 77 days where the ships were not actually operational there and bringing in income because they had to do some maintenance. They have to do this for each ship every 5 years, and I've got that built into a model that I'm going to go to in a minute for their future dry dockings that are planned. But these are some of their operational metrics, right? They have this TCE, which I think is something charter. It's the total charter equivalent, I think. Let me I can go back down here and tell you exactly what it is because they have them defined. Time charter equivalent rate, right? So this is sorry, I don't know why the T was escaping my mind, but this is basically every day that a ship is operating, how much revenue on average are they bringing in from that ship? How much, if maybe another way to view that is if somebody wants to charter out the ship, how much are they paying per day to get that ship under their control to go where they want it to go and take what they want it to ship? So that's a number that they track very well, and they call it out what it was each quarter of 2023, and they did give guidance for the first quarter of 2024 of similar range, right? I think between 75 to 80, so in the same ballpark at least. Another metric that they track is their operating expenses for those ships per day of operation. In fact, they actually track this. It's a nuance here, not per day of operation, but per day that the ship was in their possession. So even those days where the ships were dry docked, even those ships were the days where technically not operational because they had some amount of downtime, some amount of failures, they were that is still counted against here. So when we're looking at how much did it cost them per day, they're looking at every day that the ship was in their possession. And so this is basically just 13 times 365 for the year in terms of if you want to know how many days they're counting up. And they track this so that they can look at, what's the spread? What's our gross profit margin, if you will, right? 79.5 minus 14.4 would tell you that's effectively the profit they're making. Of course, there's lots of other things you have to subtract out, and I have a model for all this that I'll go through in a moment. But that gives you some indication of their level of profitability for these ships. So now if you move on to the actual, the overall financials for the company, you look at their EBITDA, revenue, and EBITDA, revenue was fairly stable. It was in this, again, $87-97 million per quarter range. Adjusted EBITDA, and I didn't go through all the adjustments because I have an actual cash flow model I kind of go through in a minute. But you can look and see the EBITDA is also fairly stable. In the same way that the revenues are fairly stable, their EBITDA is fairly stable. Their net income is, again, fairly stable, right? Because there's not a lot of surprises in this business. They didn't have wild fluctuations in their charter rates last year. They didn't have any surprises in operational expenses. This is kind of what we can expect going forward. At least expenses are going to be fairly well known. Charter rates, that is a bit of a question. I think some of these long-term contracts make this less important for the company, right? The point of being under these long-term contracts is that they actually have visibility into how these are going to be priced. This Flex Constellation, this one ship that is now no longer under contract, this I believe is going to be working off of spot rates once they get it. They have to dry dock that after it comes back into their possession once it's off of contract, and then they're going to dry dock that for 20-30 days. Let's assume that. I think that's in the ballpark of what they did with all those ships they dry docked last year, and then they're going to probably hire that out to somebody. They haven't really spoken about that quite yet, but they're not going to just leave the ship sitting idle if they can do anything about it. So this will be working at rates that are not quite as forecastable, right? It just depends on what the shipping rates are going to be at the time. Similarly, the Flex Artemis, they have one of these 13 ships that is under some sort of contract, but the contract is variably priced, right? I think these other ones are on a more fixed pricing. This variable pricing, I don't quite understand it, because they really haven't disclosed all the details there, but I think that's it's a fairly small portion of their overall fleet. So to date, I've kind of just looked at it using their overall averages and the overall TCE per day, and assume that the Artemis kind of is one of the things that really drives this variability from quarter to quarter as the overall market shipping rates go up or go down. So that's how I'm looking at this. But again, they've done a good job in the past where they had fairly stable revenues, EBITDA, and net income. There's no real surprises here in their business. One other thing before I go into the cash flow models, because the one thing you also should be looking at when you're looking at these companies and saying, well, how close are they in being able to pay their dividends versus not? How safe is that dividend? You want to look at their debt. And the debt that they have, they did a lot of refinancing over the past couple of years. I think they really focus on this in 2022 and 2023. maybe I get the time frame a little bit wrong, but I think it was in that vicinity. I think more even in 2023, where they they refinanced a lot of the stuff, and they've pushed out their maturities, so they have nothing coming due until 2028. And you can see that's even spread out a bit between 2028 all the way through to 2035, where they've got these things that are just really far out in the future. And so it's not a near-term concern, right? The near-term concern obviously is paying their interest, but not necessarily repaying any of this, or worrying about having to refinance at the currently high rates that we have. They already got all that off their books. Just for the sake of completeness, I will mention they do quite a bit of interest rate hedging, but that is that's pretty complex, and I am not enough of an expert. I really have to dig into this to give you a better idea. But the point is, I think they've actually done a fairly good job, historically at least, of hedging changes in interest rates, and using derivatives so that they can actually get a bit of a benefit when things would otherwise move in a direction that's bad for them. See, we got some questions. Wakaza asks, what companies, countries, governments, etc. use Flex LNG's services? In other words, who are the customers? Yeah. So these are, I think it varies a little bit. They do talk about the overall market here. I don't know if they've disclosed all of it. So that they talk about just the overall general market. I'm not sure that they disclose their customers. They do talk about talked about them in code. They say, let me see. They had one here where they talked about they had a super major. They don't call out all of them. I think they did say one was from Cheniere, right? Cheniere. It's in one of their press releases. Maybe it was in a prior thing I saw. Let me see if I can find Cheniere. I know Cheniere is one of their companies, right? That's a U.S. LNG exporter. Some of these are, let's see if I can find it in here. Cheniere. Yeah, so here's one where this is the 2023 Q3 report. They said in August of 2023, Cheniere Marketing exercised the option to extend the vessel or the charter for the Flex Vigilant. That's one of their ships. And so we know at least one of their customers here. Again, these are going to be either LNG exporters or LNG importers. It's one of the two. Cheniere is a US-based LNG exporter, if you're not familiar with them. Although these are as these ships kind of come out of contract, if those options aren't exercised, or if the options aren't exercised, or even if they are, once those do run out, these ships are they're talking to a bunch of counterparties, right? So I don't know that we have full transparency in all those. I could go back and look. Yeah, sorry, I don't have the answer for you off the top of my head. I could try to do a little bit of research and respond back in the comments. I've looked in the past, but again, I don't know that they disclose all of them. Cheniere clearly is one, but they're all going to be LNG exporters and importers. It's not a huge list of people who are doing this, right? You already have Japan and China, those companies, and in India to some degree. The exporters are obviously going to be, Australia, US, Qatar. Although each of those have their, it's interesting, right? Because the LNG market and the LNG shipping market are clearly correlated, but there's a bit of a difference there where it matters where the LNG is coming from and going to, in the sense that, the longer that distance is, if we're going from, U.S. Gulf Coast over to Europe, or U.S. Gulf Coast over to, Japan or China, the route that they have to go through, it's sort of a, that depends, that is what determines how much demand there actually is for shipping. If they had to go on a route that was further because they got better pricing from the U.S. versus Qatar, that is going to increase the demand for LNG shipping more than is even increasing the demand for LNG itself, right? Because the route is a long route. So, sorry, I don't know if that answered you. Yeah, I don't have a good answer. I guess this is really that was a long-winded way of me saying I'm not sure off the top of my head. Hi Kevin, thanks for hopping on the stream. Yeah, I think Flex LNG is sort of, you say you're bullish on oil and LNG. This is sort of a way to play LNG without having an opinion on the price of LNG at all, right? Flex LNG makes money whether the price of natural gas and the price of LNG, JKM, etc. are high or low. As long as these people signed a contract, and as long as they still need the LNG, they actually need the molecules. Whether there's thin margins, negative margins, super high profit margins on the LNG itself, doesn't matter. Flex LNG, somebody still has to transport. They still have to get it from the exporter to the importer, and so that's why this is a little bit more of a picks and shovels play on the LNG industry. To go into a little of the dynamics of that shipping industry itself, I am not nearly enough of an expert to go past what they really have in some of these investor presentations, because I just don't have insight into it. But they do talk about the prices of new ships, how the prices of new LNG shipping vessels have gone up over time. So they're at highs versus the prior years, and as I mentioned before, all of their ships were built in 2021 and before, so they have the benefit of lower capex that they're now amortizing over a 35 or 40-year period versus newer people who are building these ships, and so that really means when these ships come off of, sorry, I'm going back to the slide, when these ships do come off of their contracts, they're going to be competing against other shippers, of course, but they had a lower capex, so for a lot of these, they can probably accept slightly lower TCE rates, right? Slightly lower rates of the customers paying to contract their ships out, because frankly they just paid less for their ships up front. They had good timing, in being able to get their ships built at a time when the prices for the ships were not as high as they are today. And so that's really a benefit that Flex LNG has. And this is a chart showing how many new vessels are ordered, and I think are scheduled to be delivered or estimated to be delivered in the next couple of years. So there are quite a few, but they also talk about in the very next slide that let's look at the numbers here: 69, 88, 73 for the next couple of years. And so those are new ships coming online that could ship LNG. But at the same time, there's some of these older ships that are effectively getting to the end of their life, right? And so these are estimated, I think, to be pulled off the market, most likely because they are a lot less efficient, right? These are steam turbine rather than the newer technology. And I don't even know enough of the details I talked about on the earnings call, and I believe they are not BSing me, considering it's stuff they talked about on their earnings call, saying this out loud. But these older, less efficient ships probably are not competitive in terms of the cost that they can actually get, or the cost that they would have to charge versus the newer ships. And that's one thing that Flex kind of got their timing pretty nicely, at least as far as I understand it, where they got these ships built before the recent price escalators, where it's gone up by 20-25% just over the past couple of years. But they also got it new enough to have these ships to be on the more efficient side of things, right? So when you're looking at a commodity like LNG shipping, the importers and exporters don't care any of the details. They just care about how much does it cost me, right? So it's just a commodity to them, being able to get it from point A to point B. Flex has the more efficient ships, so they're able to be on the lower side of cost for that, shipping for that commodity. All right, sorry, I see some more comments. Wakaza asks, do you use LNG for your home? We use natural gas. I'm in Pennsylvania, not Virginia, and yes, I do use natural gas. It's not LNG, right? LNG would be when they liquefy it and they're shipping it overseas, where I live, they have pipelines, and so it just flows right through the pipelines. There's no need to liquefy it. Kevin asks, it says, thanks. That's awesome, Dustin. Thank you. I do like picks and shovels companies. Do you think the Yemen drone attacks will be a factor or no? Yes. And so they actually had a bit talking about it in here. The net effect here is they talk about the Suez Canal thing. Or sorry, not they talk about the Panama Canal, I think, where they were saying, hey, there's some issues with that. But yes, this one here, the Suez, where they kind of said, look, no, where is it? Yeah, here it is. Basically, sorry, let me look back at this. So this chart is showing you the route to get to Asia, the percent of each of the different routes that you could take, and they say, the number of them that have gone through the Suez Canal has, used to be throughout 2023, it was, like the higher than going through the Panama Canal or the Capes. I guess I'm not sure exactly what. I guess the Capes would be going all the way around, right? This would be the Capes. They're in Africa, and people were going through the Suez Canal because that was the most efficient route to go through. And now it's gone to effectively zero in January 2024. So the net impact of that is, yes, increased demand for shipping. And that's kind of what I said, where it's not just how much LNG needs shipped, it's also what are the routes that people are taking. So if it's less efficient, because it's less efficient for them to ship all the way around Africa versus to just go through the Suez Canal and kind of hit there, depending on exactly where they're coming from and going to. Now it is less efficient. That means more ships are needed to ship the same amount of LNG, right? Because it takes more days for those ships to go around the capes, to go around Africa, rather than sort of cutting through Africa and the Middle East there. And so yes, that is a factor, and it is a positive for Flex LNG in the short term, right? This is something that hopefully will go away at some point. Sorry, I went back to the wrong slide, but something that hopefully will go away as they sort of stabilize the region. But who knows when that will happen. And so in the interim, that will be a positive for LNG shippers like Flex LNG. And so that might be a positive, again, going back to in the very, very short term. They have the Flex constellation that is, coming off of contract, and they're probably going to contract that, in Q2, Q3, Q4 at, just spot for spot shipping rates. And, that might actually be a positive for them in the very, very short term. All right, well, Kaza says, I asked because I'm wondering which state uses LNG the most. I would think Texas, but the southern states like VA would need it too. So for most, I think in terms of states in the U.S., I'm not sure. I think they use it in the Northeast. I don't think that the U.S. itself is a large consumer of LNG, right? There's lots of states that use tons of natural gas, right? But the LNG is, you don't go through the effort of liquefying it. If there's, unless you really need to do that, you really need to get transport it somewhere far away, right? If you can build a pipeline for your gas, like again, I live in Pennsylvania. They do fracking in Pennsylvania, and so they produce natural gas here, and then they've built pipelines to lots and lots of different places, right? And so it's way, way, way more efficient for them just to frack it, get out of the ground, and then send it through a pipeline, eventually down to people's houses or wherever they use it. Than it is to liquefy, right? Because liquefaction, you have to build the pipeline to the liquefaction facility, then you have to liquefy it, and that's an expensive process. And it takes a lot to actually get that facility built, and then you have to store it in something that's going to keep it cold, so that it is liquefied. They take it down to like negative 250 degrees Celsius or something like that. It's a very, very low temperature. That's what causes it to condense and be. The whole point of liquefied natural gas, rather than just natural gas, is it takes up so much less space when it's in liquid form. Like I think 1/300th of the size of natural gas in a gas form. And so that's why they liquefy it, because then it's easier to transport. And so they really only want to go through this process when they are transporting it far away. If they can build a pipeline, then that's very, very much preferred. So I think most of the consumers of LNG are, countries that really do not produce a lot of energy themselves, and or can only, basically only get coal, and they want a cleaner energy source that's also economical. I think the customer that has been one of the large LNG importers historically has been Japan. I think they talk about that in one of these charts where they say those are exporters. Japan is those are still imports. I'm sorry, this is, oh man, I'm forgetting which one is Japan, which one is Korea. Anyways, I'm gonna look like a fool right now because I don't remember all my flags. That's the U.S. Educational system right there. We really didn't learn all these flags. Anyways, the point was that I think Japan historically has been a very large importer. Where was this? There was a slide that did talk about this a little bit here, so that I don't have to look like a fool and I can get the actual numbers. How do they use the term Game of Thrones? Yeah, so yeah, Japan used to be the largest LNG importer. I think China now is very, very recently kind of leapfrog them into to again become the largest LNG exporter. But those are, it's mostly, yeah. So what caused it fix me white with the red dot? I feel so ashamed. I don't know that. It's also harder when sorry, if you've ever been on, on a stream speaking live trying to answer questions, it really makes I seem dumber than I am, I think. It's hard to answer questions live. Anyways, moving on with what I was talking about. Let me go through the comments real quick. Wakaza says that's why we do more business with Canada. Offset use in the Middle East, of course, exploration could be better. Yeah, and yeah, okay. So I'm gonna move on with what I had for my notes and going through this. So the big question, as I kind of mentioned, is can they sustain that dividend? And this is a historical look. This will only take a moment. 2020, 2021, all the way through to 2023. You look at their net cash provided by operating activities. You look at what they paid in dividends. They've been fairly, they've had a spread on that, right? Where they've actually brought in more cash in terms of cash flows versus what they paid out until 2023. This is actually the first year where they paid more in dividends than what they brought in from operations. So that, that should be your red flag where you say, I need to investigate and to see, is this really an issue? Visually it looks like this. Green bars are how much cash they're bringing from operations. Red is their dividends paid. And then the blue bars here is just that difference where you can see it actually went negative in 2023. A large portion of this was because they dry docked so many ships. As I mentioned, they had 4 ships in 2023 that they brought in. They had to do maintenance on, basically. That's something that only has to be done every 5 years per ship. And so that's not something you're going to expect to continue on. If you adjusted that out, I think they would have been able to cover their dividend in 2023. So, and they also paid a special dividend on top of everything else. So, they were fairly confident. They could have, they have been paying 75 cents per quarter. And they paid an additional, I want to say 12.5 cents. Let me take a look. Go here for Yahoo Finance dividends. Yeah, so in November of 2023, they actually didn't pay their 75 cents. They paid 0.875 as sort of a special dividend. I think the special dividend here in February was actually paid out as part of the kind of prior year's expectation of special dividend. Let me take a look. Yeah, so they used to be paying 75 cents. That one was kind of higher than normal, but 75 cents I think is what we can expect going forward. That's what they declared for this month, right? So there is going to be a 75-cent dividend paid for holders as of well, I guess I'm not sure if that's the holders as of February 22nd or if it already happened. Excuse me. But the point is, for Q1 of 2024, it's again 75 cents. That's what we can kind of expect going forward. That's what I've looked at in the future. All right. So, oh, thanks, Wakaza. Those are very kind words. I appreciate it. All right. So I made a model here. Let me. Wakaza says, spent a lot of time in Southeast Asia during my time in the military. Japan is awesome. We're traveling to visit Hawaii and Japan. Have special friends like US and UK. Yeah, cool. I've never been to Japan. That would be a cool place to go. I would love to go there. And that's awesome that you got to that you got to go there. All right, so I built a model looking forward 2024 all the way through to 2027. Try to look at their dividend coverage. And so I'm going to go through this real quick. Obviously, they have 13 ships. I assume that stays the same. They're not building any new ships. I put in an estimate here for what their uptime will be. Historically, in some years, they've had 100% technical uptime. I put in 99.6. That's what they actually achieved in 2023. I think that's reasonable to expect them to continue. They've done a pretty good job historically. These are still fairly new ships as well. When they are dry docking them, they are doing presumably all the maintenance they need to. So, I think that number is credible. Now I put in here, what is their percent that's been contracted? And that really just comes off of that prior slide where you see, hey, we've got these contracted out all these years. And you can see in 2024, they are 94% contracted. And, that goes down 84, 65, 44 as those years march on. Again, that number is higher if I look at this following row, if those options are exercised, right? So if I go back, I'm sure you've seen this 17 times already in my presentation, but if all of these light blue bars turn into dark blue bars, right, because they actually exercise those options and these ships end up being utilized for the full time period that they have potentially contracted, that's why these numbers would actually go up to 92%, it'll only drop to 86%, in 2027 because there are sitting options on many of these ships, and a lot of times these do get exercised. I think if you look at this graphic a year ago or 2 years, I think a year ago would be a good comparison point. I don't have it offhand, but I think a lot of these, there were options that have been exercised throughout 2023, so that there's now a larger firm backlog today than there was a year ago, and I think you can expect that to continue into the future. All right, so if I look at then the number of dry dockings, are you invested in FLNG? Yes, I am. It's sorry, and I'll give you the caveat. This is not a massive position for me. I generally tend more towards stocks with growth, but I do have a small minority of my portfolio in dividend stocks, and of my dividend stocks, this is probably my largest dividend stock holding at the moment. If that gives you any indication of my conviction, right? And I am still, slowly buying more shares of FLNG as I add to my dividend portfolio. So hopefully that answers your question and gives you the amount of detail that you were looking for. Again, none of that is financial advice. Please don't buy anything only because of what I say. Please do your own research. But that is, for me personally, that's where I'm at. All right, so I also model out the number of dry dockings, the number of ships per year. This is, they have this listed somewhere. I can't remember where I pulled it, but it's 2 in 2024, 4 in 2025, 3 in 2026, and then 0 in 2027. So, and then we'll restart the cycle back in 2028. Will be 4 more as they did in 2023. So that's sort of what that schedule looks like. I have an estimate of how many, or not, I estimated how many days in total that would mean they'd be down due to dry docking. I just assumed 20 days per ship. And then I already looked at, just for a couple of these numbers, some of those ships, right, when I say how many dry docking days does that take out the ships out of commission, some of those days are already counted because those ships are not under contract anyways, right? Case in point, the Flex Constellation is not under contract for most of this year, and so I'm counting that as not contracted, but they're dry docking that one this year, so they're going to dry dock it after it runs out of contract. So even though that is less theoretical days that the ship could operate, it's already not under contract. So when I'm sort of adding up the revenue, I don't want to double count that, if that makes sense. So if it didn't, just hopefully trust me that I'm kind of doing the right thing when I model things out. So then I have a couple numbers here. I have their estimated firm operating days, right? And this is what's currently contracted, subtracting out the estimated days that they would dry docking. I have similarly the number of operating days they could have with all of the options exercised, and so that clearly is a much higher number. So even through 2027, that's where they're still at 86.5% contracted. Then I have just their max operating days. This is if every single day that they weren't dry docking, that they had these ships operating, whether they're under contract or whether they're just at spot. All right, so then I look at what is their operating expenses per day. In thousands of $1,000. So this should be in, no, that's per day, right? So $15,000 per ship per day, and so you multiply that out by their total days, and this is where the expenses come in. It's slightly higher in 2024 because there's one extra day in 2024, with the February 29th that will be coming up. But the future years, I just estimated at, the $15,000 per ship per day. And again, going back to their operational metrics that they actually did in the past, they were at 13.4, 14.6, so average of 14.4 for fiscal year 2023. So I think 15 is a reasonable estimate of their average going forward. These numbers will probably go up every year slightly because of, costs. I just kind of kept it at 15 and sort of assumed in the future these would go up, but also revenues would probably go up in tandem. So I kind of am just keeping it flat for the next couple of years to model things out. Couple questions. Let me see. Maybe a video share portfolio someday. I could talk. I've been asked that before. I have mixed feelings on doing that. I might. Is it possible to do a video on RR Rich Tech Robotics? I will note it down. I could take a look at Rich Tech Robotics. Let me make myself a note here. I will look into that. Thanks for the suggestion. And Kevin asks, Dustin, will you be covering the Tel earnings call this week? It's on 2/22. So I will talk through Tellurian once they file their 10K. They don't historically do an earnings call. I don't know how long you've been invested in the stock. They release earnings, they release press releases, but they don't actually do a call. I would love for them to do calls, to answer a couple analyst questions, but they historically haven't. But yes, I will be talking about Tellurian once their 10K is filed. There's a number of things that I look at there, and so that would be, yes, I will definitely do that. So yeah, I will look at both of those. So obviously Tellurian I covered this channel already, but Rich Tech Robotics I will take a look at fresh sometime in the future. I can't guarantee exactly when I'll get to that, but maybe in the next month or two. All right, so going on with my model here for Flex LNG, I also looked at their time charter equivalent per day. This is going back pretty similar to what they had in 2023. I put this at $81,000 per day because I assume this is going to be slightly better than 2023. Maybe that's wrong, but I assume there's some price escalators in some of their contracts, and so I just went from average of 79.5, 81. I think that's a reasonable increase. If you really do the math, that's it's like a 2% increase. I figured they have not they have to, but I'm assuming they can at least get that much in terms of whatever their annual price escalators are in these yearly contracts that they have. So I think that's a hopefully a conservative number here. Now, this gets to the actual model here. So if I model this out with just their firm revenue, I looked at their the revenue from all their ships they have under contract. I subtracted off their operating expenses from the voyages, administrative expenses. Historically this has been this is like $10.5 million for 2023. I just upped it a little bit to $11 million and kept it flat throughout this period. Again, you could quibble on whether you think that's realistic or not. Maybe I'm underselling it, but I think that's fairly credible. That gets us to a rough, EBITDA. It's not exactly EBITDA, but I'm calling it EBITDA here for the sake of this model. Where in 2024 it's at $277 million. Down to 2027, it drops quite a bit again because I'm only looking at contracted revenue. And I'm going to talk through sort of an additional model this in a moment. Other expenses they have, if I want to get to sort of an estimate of free cash flow, is they have their interest on all that debt, which is significant, right? $110 million per year. This is roughly what they paid. I think I just took the Q4 of 2023 number and annualized that, and then just sort of held it flat because again, they don't have any maturities coming up. They shouldn't have any refinancing. So I would expect this to be pretty much the same for the next couple of years. I also looked at their capex for dry dockings. I think I looked at a prior number, and I think it came out to about $5 million per ship that got dry docked. So this is just a multiplier on top of how many ships are getting dry docked per year to come up with that number. Then I have my estimate of what their free cash flow is going to be every year here. And so again, this model is only looking at their firm revenue, which is not realistic. It's realistic for 2024, probably not into the future, especially not into 2027. They're not going to, I sure hope that's not going to be the trajectory of the company to have no new contracts ever. But if I look at this and I say, what dividends could they support with that amount of free cash flow? In 2024, we're looking at $2.91. And again, this I think is fairly conservative on most of the numbers. And this also assumes that the Flex constellation that is coming out of contract does nothing. That just sits there, still costing them money, but doesn't bring in any revenue after it comes off of contract at about the end of Q1. So they could still support almost their full $3 dividend in 2024, even if that happened. Going into 2025, where again they have less contracted here. The Flex Constellation, the Flex Artemis comes off, and the Flex Courageous comes off, and so they're much lower contracted. Even in 2025, they could support $2 of a dividend. So again, doing the math here, even at $2 of a dividend here. So let's say that was a new norm. Let's say that they're able to keep contracted, 11 or what's that, 10 and a half ships, 11 and a half ships. So it's so they have 2025, 1 and basically 2 ships. So this would be contracting 11 out of the 13 ships. Even counting the expenses for all 13 though, they could still support dividend payments of $2 per share at their current share price of $26.82. That would still be a 7.5% dividend. So that's where I'm looking at this, and I'm saying, I think they're fairly, even if they cut it, it'd still be a fairly healthy dividend that they could do, even if that was a new norm. Again, if they never get any more contracts and things really fall off throughout 2026, 2027, yeah, that's going to be horrible for the company. I certainly don't expect that to be the case. But if we look at, I made another model here, which I think is slightly more realistic. let's say those ships that are rolling off of contracts don't get new contracts, even though I think they probably will. But let's say that they are able to still use them to ship things, but because they're not under contracts, they're just shipping whatever they can. So they're some days they're not operational, or when they are, they're working at a discount. So let's say on average, they ship the same number of days, right? They ship for a full year, but they actually give a humongous discount. They give a 20 or 30% discount. I think I was doing 30%. I don't know why I did 20% there. But if I look at this and I say, well, if that Flex constellation is able to get back up and running, and they're able to operate, but they're operating at a 30% discount to what the, instead of getting, $81,000 per day for the time charter equivalent, they instead get, $57,000 per day for these ships, because they're operating not under contract. They're just operating at whatever rates they can get, whenever they can get work. And so I think that's more realistic, because they're not going to just let these ships sit around and do nothing. They're going to put them to work as best they can. And so even if there was a massive discount to the tune of 30%, this is what they could cover in the future, right? They could cover $3, $4, $4.40, $4 and $3.66 over the next couple of years when I model all of those things out, And so I think that is pretty good, And if these discounts were less, they're able to support pretty good amounts here going forward into the future. But oh wait, something's wrong here. Oh, I didn't fix my formula. Sorry. Give me one moment here. Of course, I was like, well, that seems wrong. Shouldn't be in the $4 range. Here we go. These are better numbers. I apologize. I was like, wait, those. Even I was saying them, I didn't think they made sense. So, similarly here, these are wrong. How did that get messed up? Give me one moment. I can fix this on the fly. Here we go. These are more realistic. Okay. Even if, all right, rewind back, forget about the last 2 minutes I just said. Even if they had a 30% discount on their shipping rates, they could still support almost $3. So they would have to cut the dividend if they were at this massive discount, but they could still support, something more like at the current price is 9%, maybe even 10% dividend going forward in the next couple of years. And again, this is a fairly conservative state of the company where they don't get more contracts and they have to give a huge discount just to put their ships to work. If this is, let's say the discount is not that high, because that's a pretty huge discount. Let's say it was only 15%. Now we're looking at it and you can say, well, you can almost support that $3 every year. If this was only 10%, I think they probably could. Well, they're pretty close on a couple of these years, but they, because of the dry docking they have in these years, they can support slightly less. But they're very close to being able to continue paying that $3 per year every year. And again, this is I think fairly conservative. There's a lot of numbers in here that you could make an argument should be further towards one direction that are going to benefit the company. But that, I think, is how I'm looking at it. This is why I say, I think it's moderately safe. Even if they cut it a bit, let's say they did have to do these, like I said, massive 30% discounts to get their ships up and working. They can't get new contracts at decent prices. Again, this is even at 244, if I'm looking forward to 2026, at their current price, 26.82, that's a 9% yield. So even if they cut it or they lower it a bit, this is still a pretty good dividend payer. And there's a lot that's like what I see as a realistic downside. I don't think it's really realistic they're going to have to cut it so much based on how I see the cash flows kind of working out. So and then Wakaza says, looking at the 52-week high-low price, shares seem like a good entry point right now. Yeah, I think it is. And again, I think when I look at things, I like to look at this in context, right? When in doubt, zoom out. If I look all the way from the beginning, they're still up quite a bit. This is not like you see some other companies when they're imminently at the point where the dividends are going to get cut. You start to see this drop off. And if I'm looking at this, it has dropped off a bit past 6 months. People didn't really, I guess they didn't like the current state of the company, after their most recent earnings announcement, or maybe folks were expecting them to actually up their dividend for some reason. I don't know. I think the biggest thing, people who just aren't looking at it closely and aren't doing all of this analysis that I am, they look and they say, hey, 2023, all of a sudden, oh no, they paid out more in dividends than they brought in terms of, cash provided by operating activities. I think there's a lot of people who would just look at that and say, I'm out. I'm not even going to continue on with the company. It puts it in too high risk of a bucket. And again, that is the risk that you're taking, right? When you are investing in something that's at an 11% dividend yield, that's why their yield is so high at the moment. But in terms of the 52-week price, yeah, I mean it's obviously great. If you liked it back then, it's even lower now. Granted, if you bought it 12 months ago and held it, you would have received $3 or maybe a tad over $3 with that special dividend. I guess it would be $3 because of the way things worked out. In terms of dividends in your pocket, right? So if you bought it, you're here at $30.89, you would have $3 in your pocket that you could have reinvested or spent. So that is one thing to keep in mind. But yeah, I think if they're able to continue paying this, it's going to get to the point very, very quickly where, just a little bit of, contract extensions, just a little bit of new contracts for, the Flex constellation as such to really, if they signed one contract now and they said, oh, you know what, actually, this one we got a 3-year contract fully booked out through the middle of, 2027 for this ship. And now we can say, we're at like 90%. And if these options are extended, we're at 100% booked all the way through, into 2027. Like, just that one little bit would be pretty massive for this company, and that's where I really just think they're not, it's a moderate risk, right? It's not impossible that they would not be able to get a new contract for the ship, and that overall that they're not going to have these options extending. No, I'm not an expert in the LNG shipping market, but again, I kind of look at it and I say more LNG is going to need shipped. They do have additions to the market. This is one of the things where they model out here. You can look at other companies. They all have their own sort of, everybody LNG market is still making this case that, we need more LNG. More LNG is going to be coming online. The LNG exporters are making this argument because they say, come on, find contracts with us, invest in our company so that we can get our export facilities off the ground, so that we can get them, extensions signed and built. And clearly it is a growing market, right? Everybody thinks that the market is going to be bigger 5 years and 10 years from now, especially when you look at Flex LNG and you say, well, there's some new ships coming on, but there's old ships who are going to be, no longer cost competitive, and they're maybe hitting the end of their life. To some degree, it's not balanced out, but it does mean that there aren't quite as many ships coming online as it looks like when you just look at these numbers. And, that the difference between this, new ships being delivered and, existing ships that are going to be that are no longer going to be shipping anything because they're too old, has to be in balance with new additions to the LNG market itself, right? The new LNG exports are going to say, hey, we need somebody to take our LNG from our export facility to our import facility. And so, the fact that this is a growing market, I think, they're in a reasonable market. And so I don't know that there's a huge growth story for the company. So sort of tying this all together, as I said at the beginning, it's similar in that aspect to Altria Group, right? There's not a lot of capital appreciation, but in terms of the dividend safety, it's not like it's a dying market. LNG exports are increasing, and, Flex is already very well established here, and, they've got fairly modern ships. They're all from the past 5 years or so, and that's, I think, puts them in pretty good state to at least continue on with what they're, with what they've been able to do. Seems pretty likely they're going to get something for the constellation in, going forward, that they'll probably be able to cover this dividend again. And if it gets cut, I think you're probably still going to see a pretty high yield, maybe not the full 11%, maybe, 8 or 9%. But, just go into it with eyes wide open. Like, that's not the worst thing in the world. And as I said, sort of, if you do zoom out, they're still well up over, 5-year. Here's just the 5-year chart. They're almost more than doubled in terms of just the share price, let alone all the dividends that they've paid out the past couple of years, since they got these ships really online and working. So, I think it's, as I said, I'm invested in it. I think that the dividend is moderately safe. So that was all I had. I don't know if anybody has any questions or comments. I'll stay on for a couple more minutes. If I see more on the chat, I'll stay on for a bit. If not, I'll hop off. I don't want to waste anybody's time. All right, let's see. Wakaza says, true growth is there. We've been waiting for LNG for a while now. Even ET has been keen on LNG. Yeah, there's lots of companies, because, it's a great it's a great solution for these countries that right now are burning a lot of coal, right? And or just need more energy. If they don't have any source of energy, like natural gas is a great source of energy for these countries. Keep saying companies when I mean countries. Yeah. Like I said, I'm gonna stick around for another minute, see if anybody has any questions or comments on the chat. In the meantime, if you've been watching this far, I can say, I still do my live streams, trying to do them every Sunday. I don't get to do it every Sunday, but I do try to. I've been posting on, X or Twitter, to try to, say when I'm going to be live, so that if you're looking for that, usually try to post that at least an hour ahead of time. I don't always get to, but I try to. Every Sunday, I try to talk about at least one stock. I'm happy to talk about whatever now. After I get through my prepared material, I'm happy to answer questions or talk about whatever for a little bit. But mostly, I've been doing my streams on Sundays. I think I'm going to attempt to find the time to do on a weeknight, maybe Wednesdays. Not sure yet. Try to do like a Bitcoin study group, because I think there's been a lot of folks who are. I think there's a lot to I personally am fairly heavily invested in Bitcoin alongside all of my stocks. I think there's a lot, that people could learn about Bitcoin. People who don't know it, like it's not normal, right? It's not the same where I can just look at, once I kind of understand investing in stocks, I can go look at most stocks out there and kind of start do my research and get it. Bitcoin is such a different beast. It's something I personally spent a lot of time learning about, and I think it's a very compelling opportunity. So I want to also start that kind of on the side for my stock talks. So, but I'm going to try to do that as a separate thing. So if you aren't interested in Bitcoin, I'm going to start doing that hopefully soon. So just something I've been thinking about. All right. Well, Kaza says, mahalo, Dustin. Thank you. I don't see any other comments on the chat. So thank you all for being here. I really appreciate it. I have nothing else. So, Kevin says, Dustin is... sorry, it's covering up my thing. Now let me check on my phone, see if I can find the live chat, because it there's a little icon that covers up on my actual program here. Is WMB stock and MLP. WMB. So I think usually Yahoo Finance does a pretty good job. I thought they had it here. The easiest way that I do this when I'm looking for these things is, it's not great, but one thing you can do really, really quick is say, does WMB issue a K1? And almost all the time, lots of times you can get this. Here we go. FAQs for the investor relations. Lots of time, the company itself will answer that if they are an MLP. There was a merger. WPZ unit holders. It looks like maybe they used to be, but now they're not anymore. I don't know. So I can't tell you off the top of my head. It looks like maybe they used to be and they're not anymore, if I'm reading this correctly. Because they talk about unit holders, right? And if it's an MLP, you're not a stockholder, you're not a shareholder, you're a unit holder. So they're talking about this WPZ, and so I'm guessing that was the case. So let me read this. Okay, each WPZ public unit holder will be entitled to receive Williams common stock. So again, don't treat this as a definitive answer, but it looks like maybe they used to be a partnership. They used to be an MLP and they're not anymore. It looks like this WPZ might have been. Now maybe when they converted into WMB, they're not. So let me see. Yeah, so it looks like it's. Sorry, this is, I don't know what this is. Well, this is somebody else's article, but so this isn't definitive. You should be skeptical. And this is from Money Show. I don't know what Money Show is. You should be a little bit skeptical of these, but sometimes it can provide you a little bit of information. They say it's well worth noting the company acquired the remaining 26% ownership from its limited partner. It's now a regular corporation. It's not an MLP. So if you trust whatever this is, and a lot of the time, like a fact like that, I wouldn't think they're lying about, at least not intentionally. Let me see. What are the expected tax consequences, right, as a result of the merger? trying to see here. It looks like they're probably, for my super quick, searching here, it looks they probably are not an MLP anymore. It looks like at one point this company was, or at least this other ticker WPZ was. So let me even say, I don't know if they had. So we go to company filings, WMB. Let me see if there's. No, I'm not finding what I was looking for here. That's my best answer for you. Off the top of my head from super quick research. I'm not sure exactly how they denote this in the SEC filings. I guess. Let me look at if I look at their maybe balance sheet. Yeah, I'm not sure. That's my best answer for you. It looks like they're not. So hopefully that helped a little bit. Usually just say, yeah, I think since a company is saying you're going to get your final schedule K1, right? If it's an MLP, you get a K1, you don't get a 1099, right? And so that's, sorry, if you're a U.S. resident. If you're not a U.S. resident, I have no idea what the implications are of something being an MLP or not an MLP. But, to me, I have been invested in MLPs before, and instead of getting a 1099, you get a K1, and you're a unit holder in the partnership, not a shareholder in the company. And so it's just different than most other stocks. But since they're saying here, WPZ unit holders will get a final schedule K1, on in 2019, and they're talking about a merger. It sounds like they did used to be, and now they aren't anymore. Here, no, where can I find more information? Yeah, there's a ton of information here on this SEC filing. So probably if you read through this whole thing, this would tell you your answer somewhere in here. Sorry, I'm not going to read through this whole thing live on the stream, but that probably has your definitive answer somewhere in here to tell you really what, to tell you exactly what happened here. So hopefully that helps. All right. I don't see anything else in the chat. Kevin says thank you for checking. Appreciate it. You're welcome. Sorry that wasn't. Let's say from looking at, I would be personally confident to invest in it and expect that it's not an MLP. But I'm like 90% sure based on that research, not 100%. You'd have to probably again read through this whole thing if you really want to see what happened. Just for again for the to be clear on the level of uncertainty there. But I don't see anything else in the chat, so I'm gonna hop off now. Appreciate all of you who were on the chat. Thank you very much. And I will be back here next Sunday. I don't know what we'll be talking about. I'll figure that out this week. Yeah. Thanks everybody. Have a good one.